Welcome investors. Today's our market update for February 8th. I'm Grant, this is Gary. Adam Carlini is also a member of our team, and we're Dynamic Wealth Management. We had a fun Super Bowl weekend. Hopefully all you Broncos fans out there enjoyed it, were able to watch the game. We would love to see Peyton Manning go out on top one last time like that. Unfortunately, the rest of the news we have for the video is pretty much bad news. The market's been going down. We had a rough week, and actually today, Monday, February 8th, another big down day in the market, and we're breaking key levels here.
That's correct. We started January pretty bad. You'll remember our first couple weeks of January just terrible, and unfortunately it looks like February is starting off bad as well. So let's give you some more information about what's going on in the economy, the market, and how we're reacting to that in our models. Okay folks, good to be with you again. Let's start by giving you a quick update on where we are, what events we have coming up. Again, we have non-formal events here in the office. We call them investments for breakfast. The next one is a couple Tuesdays away from now, February 16th, and every 2 weeks we do those. So the following one after that will be March 1st. And again, that's on a Tuesday, 9 o'clock here in the office. Very informal. Give you an update on everything that we're seeing just in much more detail. Also, we have formal seminars. If you want to come out and find out how we do what we do, we have been out of this ugly market for the last almost 4 weeks now. So what do we use as our indicators? How do we do what we do? We'll give you more information on that. So February 11th, we will be in Sun City Festival. That will be a 9 o'clock meeting there, and then we will be back February 23rd, which will be a late afternoon evening dinner meeting in Sun City Grand. So give us a call. We'd love to have you, your spouse, any friends that you'd like to see. So let's give you a quick update on everything that where we are in our allocations, and then we'll walk you through why we're there in detail, especially when we talk about the market. We are still in that bearish zone. Like I said before, we've been here now. I think this is into our third week, and we'll show you exactly why. But things recently have gotten us further into the red zone. And remember, these are different allocations, right? Different regimes. So we have been defensive on this marketplace for about 3 weeks now. Let's give you some key economic things that have come through over the last 2 weeks. Let's tell you about the unemployment or the employment report that came out last Friday. So to give you the highlights, the market was anticipating the creation of about 188,000 brand new jobs. Actual number came out to be 151. So it surprised the markets a little bit on that in that regard to the downside. Now, the good news on that report was that the unemployment rate trickled down to below 5, which was a positive. So overall, though, the markets did take that negatively. And why did they? Because, the two strong parts of the economy are employment and the housing market. So if the employment situation is starting to look a little soft, or this might indicate we might get into a soft spot, that is not good at all for the economy and our ability to stay afloat as far as that goes. Other major news that came out over the last week and a half, we had Japan about a week ago that came out and startled the markets a little bit, but actually it proved to be a little bit of a positive for the market, at least for a couple days. The Bank of Japan announced that they were going to enact negative interest rates. Now, this is not the first central bank to do it. We also have Denmark, Sweden, Switzerland, and the European Central Bank that are now all giving negative rates. What that means, quite simply, is that you put your money in the bank and you are charged to leave your money there for it to be protected by the government. Obviously, what they're trying to do is have people take money out of the bank and move them into more risky assets as far as investments and so forth. So they are pulling out all the stops globally to try to get this economy going worldwide. The other thing recently that has come out over the last few weeks, we've been involved in earnings season, and we thought that this was telling. Overall, this chart is tracking earnings per share growth of the S&P 500 companies. So what you're seeing here is the most recent quarter, and as you can see here, it's negative as far as negative growth. The last times we had substantial negative growth over a couple year period of time was back in 2008 and 2009. Prior to that was 2001. Why are those significant? Because those coincide with periods when we had recessions in this nation and globally as well. Are we saying we're beginning to go into a recession? No, we're not saying that yet because the evidence isn't there. But obviously, to have an earnings season that is on the negative side that way, earnings per share is not a good thing for us. So with that, let's give you some more information as to how the market reacted to that information, and we'll turn things over to Grant.
All right, Gary did a great job of showing us some economic key events and indicators. Let's jump into the stock market and see what it's showing us. So here we take a picture, right, and we have some risky assets here, some equities, and we have some commodities and some treasuries as well. So what this is showing us is that U.S. stocks, international developed countries, emerging markets, real estate, high yield bonds are all down, and these are all considered your more risky assets. And what is up? Well, your treasuries are up, which is where 75% of our current allocation is actually in these treasuries. So we made our move back on January 11th away from these assets and towards these assets, and so I'll show you what that looks like with the S&P 500 in a couple charts here. So here's the S&P 500. One thing to note is that if you go back to the previous high here back in July, we're actually down 14% from there all the way down to here. And it's been a rocky ride. We had that big dip in August and it bounced back, and then here's our big drop again to start 2016. So we actually, January 11th, well, where was that? It was right about here. It's in this level. So this is where we moved our allocation into the red zone and where we got into treasuries and bonds, and the market is down 4% from there. And we've actually been able to make a little bit of money as that has gone down, as treasuries have bounced to the upside during that time. So we feel good about our allocation. The other thing to note is that there's this line of support, strong support, that the market's been kind of playing with, right? Bounced off of it there, bounced off of it there, bounced off of it there, and here we are again. Now today, February 8th is breaking through this support line with authority. So we're watching that carefully, and we're going to see if it can rally back up past there. But if not, then we are feeling really good about our allocation, because most likely this will fall further if it can't hold this level here. Here's a zoomed in version of the S&P 500, and this is that same support line. You'll see it's kind of just been dancing even on a day-to-day basis. Here it dropped, but it closed right up here again. So it's been dancing on this line, but look today, it actually gaps down and has stayed down beneath it all day so far. So the day's not over yet, but it's looking like it's going to close beneath and give us some direction and finally break this level. Here is the US dollar. Well, with it's been rising as other countries have been stimulating and devaluing their currency, but just recently we saw a big drop in the dollar, and of course for precious metals and gold, that was a big strong pop, but back up to kind of a resistance level here. But we could get interested in gold if we see the dollar to continue to come down and the stock market crash. Sometimes gold is a good position to pick up on the short term. Oil, on the other hand, as you would expect, because it's a commodity, you would expect it to come up as the dollar goes down, but actually it did not. Even with the dollar coming down, oil was still down as well. So that's a sign of weakness for us out there that we are watching carefully. But oil just continues to downtrend, as do all commodities except precious metals. So where are we allocated? We already talked about it a little bit, but that we just started our 4th week in the red zone here. So during that time, the stock market has come down since January 11th, and we almost got back into the yellow zone, but was a good thing that we did not, as we stayed in our red allocation. which is, of course, the same across all of our models. So if you're a growth, moderate, conservative client in our core ETF model, you are 100% in high quality bonds and treasuries at this point. So, like we said, not only does that put you in a position to not get hurt as the market falls apart, it puts you in a position where you could make a little bit of money on the upside. So, feeling very confident about where we're allocated right now. We would love to see the market drop a bit further and give us some real bargains to buy on the downside so that we could get some good participation to the upside. But for now, we're feeling very confident about where we are allocated. That being said, we want to get our disclosures out there. This is in no way a recommendation to buy or sell anything. We do not know your specific situation, so we can't make specific recommendations for you. Always consult a financial professional before making any financial decisions. We really appreciate you watching our video. We will continue to put one of these out each week. Hopefully you've been enjoying them and sharing them with your friends. We'll talk to you again next week.